Many people look for income in retirement such that they don't need to do anything to their portfolio. They never need to sell any assets. They can just live off the dividend payments they receive. But the problem is that some investments that pay high dividends are often poor quality, and they actually turn out to be a yield trap that gives unstable dividend payments, much lower dividend payments when there's a recession. They can also have capital depreciation of their assets, which they don't want. And then on the other hand, you can get things like dividend heroes, but maybe they don't increase their dividends that much over time, or maybe the initial yield isn't quite high enough to fully live off the income. So here's an example of an investment that has fairly erratic dividend payments, and the highest payout was 2018. It's got a declining asset price, and although the dividend yield is pretty good, don't forget that when it's stated over a declining price, it's really artificially inflating the actual payout that you're getting. So we could look to an active fund to try and give us a higher dividend yield. And here is the price performance and the yield of some of the most popular UK equity income funds. And we can see that there is an outlier in terms of yield, which is the Schroeder Income Maximiser, that here it's saying the yield is 7.5%, although it actually targets a yield more like about 7%. So we're going to look at the Schroeder Income Maximiser in more detail to see what it does and whether it's worth putting into our portfolio. So here is the fund, and it says that to enhance the yield, the investment manager selectively sells short-dated call options over individual securities held by the fund, and it agrees strike prices above which potential capital growth is sold. It has a risk rating of 6, and you can see it targets an income of 7%. What the fund is doing is it's offering options in companies where it thinks the price will decline, and it sells those to people, generates some what's called covered call income that's around 3%, that then enhances the yield it already gets on the Ftse 100 anyway. And when it sells these call options, if the price goes up, the underlying funds, then the growth is essentially given to the holder of the call option. If the price of the share goes down or stays relatively flat, then there is no profit from the covered call. So sometimes this will work out, sometimes it won't. And generally, we probably assume it would break even. So what it's doing is making probably overall a loss in terms of capital on the covered calls, but then just substituting that into income. So the overall returns should be vaguely similar to the Ftse 100, depending on how good it is at writing these covered calls. And then what you've got in terms of performance is a difference in fees, where this fund charges 0.35%, whereas a tracker would charge about 0.07%. And the underlying asset is always the Ftse 100. So essentially, you're trading capital growth for income, but the underlying number of shares that you have in each of the Ftse 100 companies is always the same. So for covered call options in a strongly rising market, they will underperform, as the holders of the covered call options will get the capital growth. But in a stagnant or declining market, then the writer of the covered call options, in this case the fund, will do well because the covered calls will generate income. Here's some performance data for the US Income Maximiser. It's underperformed in all years apart from 2022, when the losses weren't quite as great as that in the overall S&P 500. This is the performance of the fund in calendar years against the MSCI World Index. What's interesting is that the fund has never made a loss in the recent calendar years, although when global markets have been surging, the fund has clearly underperformed. So in hindsight, it's quite useful insurance against bad markets, but it's not really going to outperform in a standard bull market. company called Global X have come up with a NASDAQ 100 covered call product. It's an exchange traded fund. And here we've got its performance compared to the NASDAQ 100 itself. And we can see that it's not as volatile, but when the NASDAQ has outperformed, then the covered call has lagged in performance as the call options have reduced the overall returns of the fund. So therefore, I'm not so keen on this one, although it would provide some insurance if you were quite nervous about the NASDAQ. My conclusion is that covered call funds aren't without risk. However, they do offer income upside without you really having to do anything, and you can pick your underlying equity structure to fund your dividends, be it Ftse 100, S&P 500, maybe some other index or active portfolio of funds. So I think they're worthwhile looking into and tracking for a while to see whether they're ultimately to your liking. Subscribe, like, let me know what you think in the comments, and check out this next video.